I didn't set out to beat Wall Street. That wasn't the dream. The dream was simpler, cleaner. I wanted to understand the hidden language beneath the noise, the patterns no one else could see. Most people think the market is chaos, random, a casino dressed in silken numbers. But I knew better. I'd spent my life studying codes, breaking them, building them. From the back rooms of the Institute for Defense Analyses to the chalkboards at Stony Brook, I learned something that traders never did. Everything speaks, if you know how to listen. My name is Jim Simons, and for 40 years, I ran the most successful hedge fund in modern history. We didn't just beat the market. We redefined what was possible. 39% annual returns, after fees. For decades, while others stumbled through crashes and collapses, we compounded in silence. But this isn't a story about money. It's a story about discipline, about replacing intuition with evidence, about learning to sit still while the world around you screams. It's about the one rule that changed everything for me. A rule so simple, so obvious that most people ignore it completely. And it cost them everything. I was a mathematician long before I was an investor. Numbers were my first language, not the kind they teach you in school. The kind that live in the space between certainty and doubt, topology, differential geometry, string theory before it had a name. I wasn't chasing wealth, I was chasing truth. But in 1978, something changed. I started managing some money on the side, just for friends, colleagues. I thought it would be interesting. A puzzle, I'd apply the same rigor I used in mathematics to the market. See what happened. I lost money immediately. Not because I was stupid, but because I was human. I made trades based on what I thought would happen, what felt right, what the news told me. I watched my positions every day, adjusted, reacted, tried to outsmart the chaos. And the chaos won. That's when I realized something most traders never do. The problem wasn't the market. The problem was me, my emotions, my ego, my need to feel in control. Every trade I made carried the weight of my fear and my pride, and both of those things were liabilities. So I asked myself a different question. What if I removed myself from the equation entirely? What if instead of trying to predict the market, I just listened to it? What if I built a system that could see what I couldn't, that could act without hesitation, without doubt, without the weight of a bad morning or a winning streak? That question changed my life. Renaissance Technologies wasn't born from ambition. It was born from humility, from the quiet acknowledgement that I wasn't smart enough to outsmart millions of other traders. But I was smart enough to build something that could process more data, test more patterns, execute faster. I hired physicists, mathematicians, cryptographers, people who'd never touched a stock in their lives. And that was the point. I didn't want traders. I wanted people who understood systems, who could write code, who wouldn't flinch when the data told them to do something that felt wrong. We started small, commodities, futures, looking for inefficiencies, tiny edges that repeated over and over. We didn't need to be right every time. We just needed to be right more often than we were wrong. And we needed to stay disciplined. The early years were brutal. The models would work for months, then collapse. We'd lose money in ways we didn't understand. Patterns would vanish. The market would shift. I'd wake up at 3 in the morning wondering if I'd made a terrible mistake. But I kept building, kept refining, kept trusting the process, because I knew something the rest of Wall Street didn't. The market isn't random. It's complex, and complexity hides order. You just have to look long enough. By the mid-'80s, we'd found it. Not the Holy Grail, just small, repeatable edges, patterns in price movements, correlations between assets, signals buried in volatility. None of them worked alone. But together, layered, executed with precision, they compounded into something extraordinary. And that's when I learned the rule, the one rule that separated us from everyone else. The rule wasn't about intelligence. It wasn't about speed. It wasn't even about data. The rule was simpler than that. So simple, it sounds almost stupid when you say it out loud. But I'll tell you what it is, and why it works, and why most people will never follow it. Because following it means giving up the one thing humans crave most: control. The rule is this: never override the system. It sounds simple, almost trivial, but let me tell you what that really means. It means when the model tells you to buy, and every instinct in your body screams sell, you buy. It means when the news is catastrophic and the world is ending, and your gut says get out now, you hold. It means when you've been winning for weeks and you feel invincible and you want to increase your position size, you don't. You trust the math, not yourself. Most traders can't do this. They build systems, spend months, years even, testing strategies, back testing, optimizing. Then the moment the system does something uncomfortable, they intervene. They think they're smarter than their own creation. They think this time is different. And they destroy everything. I learned this the hard way. In the early days of Renaissance, I'd built what I thought was a solid model. It worked beautifully in testing. Then we went live, and within 2 weeks, it started making trades I didn't understand, positions that felt wrong. I'd sit there watching the screens, my hand hovering over the keyboard, ready to shut it down. One morning, the system bought crude oil futures, a lot of them. This was during a period of declining prices. Every analyst on Wall Street was bearish. The fundamentals looked terrible. And here was my algorithm, buying aggressively into a falling market. I overrode it, closed the position. Felt smart doing it. 3 days later, oil spiked. The system would have made us a fortune. Instead, I cost us money, and worse, I broke the only rule that mattered. That's when I understood. The machine wasn't wrong. I was. My intuition, my analysis, my years of experience, none of it mattered. The model had seen something in the data I couldn't see. A pattern, a correlation, something that existed in the noise that my human brain was too slow, too biased, too emotional to recognize. From that day forward, I made a promise I would never interfere again. We built systems to enforce this. No manual overrides, no discretionary trades, no gut feelings. If the model said buy, we bought. If it said sell, we sold. If it said do nothing, we did nothing. The humans became servants of the machine, not the other way around. And that's when everything changed. Our returns stabilized. The volatility smoothed out. We started compounding at rates that seemed impossible. Not because we got smarter, but because we got out of our own way. Wall Street hated this. They still do. They can't accept it. The entire industry is built on the myth of the brilliant trader, the man with the golden gut, the genius who can see what others can't. They write books about these people, make movies, build legends, but it's all fiction. The truth is, humans are terrible at trading. We're wired for survival, not statistics. Our brains look for patterns that aren't there. We panic when we should be calm. We get greedy when we should be cautious. We remember our wins and forget our losses. We're emotional, irrational, inconsistent. The market doesn't care about any of that. Building the machine wasn't just about writing code. It was about building infrastructure. Systems that could handle massive amounts of data, clean it, process it, test it. We needed speed, reliability, precision. We hired people who understood this. Engineers who'd worked on signal processing, cryptographers who'd broken codes for the NSA, physicists who'd modeled particle interactions. None of them came from finance. That was intentional. Finance people bring baggage. They have opinions, theories, biases. They think they know how markets work. They'll look at a data set and see what they want to see, what confirms their beliefs. Scientists don't do that. Scientists follow evidence. They test hypotheses. They're comfortable being wrong. They understand that the universe doesn't care about their opinions. It operates by rules we can discover but never fully comprehend. That's the mindset we needed. We built models that looked at everything: price movements, volume, volatility, correlations across assets, time of day, day of week, seasonal patterns. We tested thousands of variables. Most of them were noise, but some of them, a tiny fraction, had predictive power. Not much, maybe 51% instead of 50. But that was enough, because we could compound that edge, trade it thousands of times across dozens of markets, and the math took care of the rest. People ask me all the time what the secret was. What was the magic formula? And I tell them there wasn't one. There was no single insight, no holy grail, just a lot of small edges layered together, executed with absolute discipline, and the willingness to trust the system over ourselves. That's what they can't accept. They want to believe that somewhere in our code was genius, some revolutionary algorithm. But the truth is simpler and harder to swallow. We just removed the human. Let me tell you what happens when you remove emotion from trading. You stop losing money in stupid ways. That's the first thing. Not the most profound, maybe, but the most immediate. You stop selling at the bottom because you're scared. You stop buying at the top because you're greedy. You stop revenge trading after a loss. You stop doubling down on winners because you feel lucky. All the things that destroy retail traders, they just disappear. But it goes deeper than that. When you remove emotion, you can finally see the market for what it actually is. Not a battle, not a game, not a test of intelligence or will, just a system, a complex adaptive system with patterns that emerge from millions of independent decisions. Most traders anthropomorphize the market. They talk about it like it's alive, like it has intentions. The market wants to go higher. The market is testing support. The market is punishing the weak. None of that is real. The market is just information flowing through a network. Buyers and sellers exchanging assets at agreed prices. That's it. There's no consciousness, no intent, no personality. When you see it this way, everything becomes simpler. You stop trying to predict what the market will do. You start observing what it is doing. There's a difference, a critical one. Prediction requires a model of causation. You need to understand why things happen. Why did this stock go up? Why did that currency fall? What's the story? What's the narrative? And humans love narratives. We're wired for them. We can't help but create stories to explain random events. But observation doesn't require causation. It only requires correlation. If X happens, Y tends to follow. You don't need to know why. You just need to know that it's statistically significant and repeatable. This was revolutionary for us. We stopped asking why. We stopped reading the news, stopped listening to analysts, stopped caring about earnings reports or geopolitical events or any of the things that Wall Street obsesses over. We just watched the data, and we found patterns. Lots of them, most were weak, some were meaningless, but a small fraction, had real predictive power. Not perfect, never perfect, but consistent enough to exploit. Here's an example. We noticed that certain combinations of price movements in Japanese equity futures correlated with movements in European bonds 12 hours later. Not always, not even most of the time, but often enough that it was statistically significant. Why did this correlation exist? I have no idea. Maybe there was some fundamental connection, some shared exposure to global liquidity or risk sentiment. Or maybe it was just noise that happened to persist. It didn't matter. What mattered was that we could test it, back test it over years of data, verify that it held, then trade it systematically. Take positions based purely on the signal. No judgment, no interpretation, just execution. And when the correlation broke down, as all correlations eventually do, the system would detect it, stop trading it, move on to something else. No emotion, no attachment, no ego. Human traders can't operate this way. I've watched it happen over and over. They find a strategy that works, make money with it, start to believe in it, give it a name, tell people about it, build their identity around it. Then the market changes, the strategy stops working, and they can't let go. They keep trading it. Convince themselves it's just a rough patch, that it'll come back. They lose money, get frustrated, Trade larger to make it back faster, lose more. Get frustrated. Trade larger to make it back faster, lose more. By the time they admit it's over, they've given back months or years of gains. We never had that problem because the system didn't care. It had no pride, no reputation to protect. It would trade a strategy today and abandon it tomorrow without hesitation. No nostalgia, no loyalty, just cold, relentless optimization. This is what people miss when they talk about algorithmic trading. They think it's about speed, about executing trades faster than humans. And yes, speed matters, but that's not the real advantage. The real advantage is emotional consistency. A human has good days and bad days. They're sharp in the morning, tired in the afternoon. They're confident after a win, shaken after a loss. They get sick, they get distracted, they have fights with their spouse, they drink too much coffee or not enough. All of that affects their trading, even if they don't realize it. A machine has none of those problems. It's exactly as disciplined at 3 in the morning as it is at noon. It doesn't care if it lost money yesterday. It doesn't get excited about winning streaks. It just executes, every single time, the same way. That consistency compounds over days, weeks, years, decades. By the late 90s, Renaissance was managing billions. Our medallion fund was the best performing fund in the world, and we did it by being the most boring traders on the planet. No big bets, no market calls, no dramatic pivots, just thousands of small trades, most of them profitable by tiny margins, compounded relentlessly over time. People called it black box trading, like it was magic or mysterious. But there was nothing mysterious about it. It was just math, applied systematically, without emotion, without deviation. And that's the part Wall Street still refuses to accept. They want trading to be an art, a craft, something that requires intuition and experience and wisdom. But it's not. It's engineering. And the best engineers are the ones who trust their blueprints more than their instincts. There's a mathematical concept most people understand intellectually, but never truly grasp. Compound interest. Einstein supposedly called it the eighth wonder of the world. Whether he actually said that, I don't know. But the sentiment is right. Compounding is the most powerful force in finance and the least understood. Here's what people miss. It's not about the rate. It's about the consistency and the time. A 39% annual return sounds extraordinary, and it is. But that number alone doesn't tell the story. What tells the story is doing it year after year, through bull markets and bear markets, through crashes and bubbles, through recessions and recoveries, never deviating, never stopping. That's what creates wealth. That seems impossible. That's what turned Renaissance from a small fund into a legendary one. Not because we had one great year, but because we had 40 good ones. Let me give you some context. If you'd invested $100,000 in the medallion fund in 1988 and left it there, by 2018, it would have been worth something close to $800 million. Not through luck, not through genius market timing, through mathematical consistency applied over 3 decades. Most investors can't achieve this, not because they're stupid, but because they can't stay in the game long enough. They panic, they chase returns, they switch strategies, they get bored, they think they can do better somewhere else. They break the most important rule of compounding. Don't interrupt it. Every time you exit a position early, every time you switch strategies, every time you take money off the table because you're nervous, you reset the clock, you lose time, and time is the only variable you can never get back. Warren Buffett understood this. He talks about it constantly. Find something good and hold it forever. Let time do the heavy lifting. But even Buffett is trading on intuition, on fundamental analysis, on his ability to evaluate businesses. We didn't need any of that. We just needed edges, small statistical advantages, and the discipline to compound them. Here's what that looked like in practice. We'd make thousands of trades a day. Most of them made or lost tiny amounts. A few basis points here, a fraction of a percent there. If you looked at any single trade, it would seem meaningless, trivial even. But multiply that by volume, by frequency, by time, and those tiny edges become massive. Think of it like card counting in blackjack. No single hand matters. You're not trying to win every hand. You're trying to shift the odds slightly in your favor. Then you play enough hands that the math works itself out. Over time, the house edge disappears. You become the house. That's what we did in the markets. We became the house. But here's the part most people struggle with. Being the house is boring. Incredibly boring. There's no drama, no excitement, no adrenaline rush. You're just grinding day after day, week after week, watching tiny numbers accumulate. Human psychology rebels against this. We're built for excitement, for stories, for wins we can feel. A 40% gain in a day feels better than a 1% gain repeated 40 times, even though the math is the same. This is why retail traders lose. They're playing for excitement, not returns. They want to feel smart. They want to tell their friends about the big winner they called. They want the dopamine hit. And the market takes their money. Professional traders are better, but not by much. They're compensated on quarterly performance, judged on annual returns, pressured to explain every decision. So they take bigger risks, make bolder calls, try to manufacture returns even when the opportunities aren't there. We didn't have that pressure. Medallion was closed to outside investors. We were trading our own money. There was no one to impress, no quarterly reports to outside investors, no redemptions to worry about. So we could just compound patiently, relentlessly, without interference. This gave us another edge. Time horizon. Most funds are forced to think in months or quarters. They need to show results quickly or they lose capital. This creates a bias toward short-term thinking, toward volatility, toward strategies that produce visible wins. We could think in years, decades even. If a strategy was working over the long term, but having a rough quarter, we didn't care. We just kept running it. Let the probabilities play out. Trusted the math. This is the part about compounding people never talk about. It requires faith, not religious faith, mathematical faith. The belief that if your edge is real, if your process is sound, time will prove you right. But you have to give it time. I've seen brilliant traders blow up because they couldn't do this. They develop a great system, test it thoroughly, have complete confidence in the math, then hit a losing streak, not because the system was broken, just because of variance, random chance, the same reason a coin can land heads 10 times in a row even though it's 50-50. And they'd panic, shut down the system, start over, chase something else. They killed compounding before it had a chance to work. We never did that. When we hit drawdowns, and we did, we'd analyze them, make sure nothing fundamental had changed, verify the system was still functioning as designed, and then we'd keep running it because we understood something most people don't. Variance is part of the equation. You can't have positive expected returns without accepting negative variance. They're two sides of the same coin. The only way to win is to stay in long enough for the expected value to overcome the noise. That's what time does. It smooths variance. It makes the signal visible through the noise, but only if you don't interrupt it. By the 2000s, we weren't even really trading anymore. We were farming, planting seeds, watering them, waiting for harvest, then planting again. Boring, systematic, profitable, and that's the truth no one wants to hear. Getting rich isn't exciting. It's not dramatic. It's not a test of courage or genius or will. It's just math, plus time, plus the discipline not to interrupt it. Let me tell you about the power of silence. Renaissance was famously secretive. We didn't publish our methods. didn't give interviews about our strategies, didn't present at conferences. When people asked how we did it, we smiled and said nothing. Wall Street hated this. They called us arrogant, paranoid, said we were hiding behind smoke and mirrors, that if our methods really worked, we'd be willing to share them. But they missed the point entirely. Silence wasn't about protecting secrets. It was about protecting the edge. Here's what happens when you talk about a trading strategy. First, you tell a few people. Those people tell others. Eventually, someone with capital hears about it. They start trading it. Then their competitors notice. They reverse engineer it. Soon, dozens of funds are running variations of the same strategy. And the edge disappears. It doesn't vanish because the strategy stops working. It vanishes because too many people are exploiting it. The market adjusts, prices move faster, spreads tighten, the inefficiency gets arbitraged away. This is how every profitable strategy dies. Not from failure, from success, from too many people knowing about it. So we stayed quiet, not just about our methods, about everything. Our returns, our size, our positions. We operated in darkness, and that darkness was an asset. While other funds were publishing white papers and courting investors and building brands, we were just compounding. While they were on television explaining their market views, we were running code. While they were networking at conferences, we were testing new models. We didn't waste time on theater, on performance, on the social game of finance. We just worked. This required a different kind of discipline, not just intellectual discipline, social discipline, the discipline to resist the urge to be known, to be recognized, to be celebrated. Humans want acknowledgement. We want people to know when we've done something impressive. It's hardwired. Status matters, reputation matters. We build our identities around our accomplishments, but sharing dilutes the advantage. I watched this play out over and over. Smart traders would develop something innovative, make a lot of money. Then they couldn't help themselves. They'd write about it, speak about it, want credit for their brilliance. And within months, the strategy would stop working. They traded their edge for ego, and they didn't even realize they were doing it. We never made that mistake. The people who worked at Renaissance signed non-disclosures, not just standard agreements, serious ones, with real teeth. We protected our intellectual property the way tech companies protect source code, because that's what it was. Code, algorithms, data infrastructure, all of it could be replicated if someone knew how it worked. So we made sure no one knew. This created another advantage: stillness. Most funds are constantly pivoting, chasing new strategies, responding to competitors, trying to stay ahead of market trends. They're in motion all the time, and motion creates friction. Friction creates mistakes. We barely moved. We develop a strategy, test it thoroughly, deploy it, then leave it alone for years. We weren't reactive. We weren't trendy. We didn't care what anyone else was doing. We just ran our systems and let them compound. This is harder than it sounds. The market changes constantly. New technologies emerge. Regulations shift. Competitors innovate. There's always pressure to evolve, to adapt, to do something different. But adaptation for its own sake is dangerous. It introduces new risks, new variables, new ways to break what's already working. So we had a rule: don't fix what isn't broken. If a strategy was still producing its expected returns, we left it alone. We didn't optimize it. We didn't upgrade it. We didn't make it fancier. We let it be. This goes against every instinct of ambitious people. Smart people want to improve things. They see inefficiencies and want to fix them. They look at working systems and think about how to make them better. But in trading, better is often the enemy of good. Every change introduces risk. Every modification creates the possibility of unintended consequences. The safest thing you can do with a working system is leave it alone. This was discipline of a different kind. The discipline to be satisfied, to not chase marginal improvements, to accept good enough when you already have it. Most traders can't do this. They tinker, they optimize, they over-engineer, they turn profitable systems into complicated ones, and complicated systems fail in complicated ways. We kept everything as simple as possible. If a model had 10 variables and we could cut it down to 5 without losing performance, we did, not because we were lazy, because simplicity is robust. It breaks less, it's easier to understand when something goes wrong. And things always go wrong eventually. The market had plenty of moments that tested us. Flash crashes, currency crises, the 2008 financial collapse. Every time there were opportunities to panic, to override the systems, to get clever. We never did. We just kept running the models, let them execute, trusted the math, even when it felt insane to do so. In 2008, while the rest of Wall Street was imploding, Medallion was up 80%. Not because we predicted the crisis, not because we had some brilliant insight about subprime mortgages, but because our systems detected volatility patterns, recognized opportunities in the chaos, and executed without hesitation. While human traders were frozen by fear, our algorithms just kept trading. That's the ultimate form of discipline. The ability to act when everyone else is paralyzed, not through courage, but through systems that don't feel fear in the first place. This is what silence and discipline really mean. Not just keeping secrets, not just following rules, but building a structure that removes human weakness from the equation, that operates regardless of how you feel, regardless of what's happening in the world. A structure that just runs quietly, consistently, profitably, while everyone else is making noise. Now let me bring this forward to today, to the world you're living in right now, because everything I've told you about markets applies to something much bigger: artificial intelligence. We're living through a transition, the same transition we went through in finance 40 years ago. The moment when human intuition stops being the most valuable asset, when systems become better than experts, when algorithms outperform instinct. They're wrong, and most people are responding exactly the way traders did in the 80s, with denial, with resistance, with the belief that their experience and judgment will always matter more than data and computation. It's happening everywhere, in medicine, in law, in engineering, in creative work. The same pattern repeating across every domain. This isn't a prediction, it's math. But here's what matters. The lesson isn't that humans become irrelevant. The lesson is that humans need to change their role. Stop trying to be the smartest person in the room. Start building the room. Not because humans aren't brilliant, but because we're inconsistent. We have limits. We get tired. We're biased in ways we can't even see. And in any field where decisions can be quantified and outcomes can be measured, systems will eventually outperform us. This is already happening in investing. You have teenagers today building algorithmic trading systems in their bedrooms, running back tests on free data, deploying strategies with a few $1,000s, things that would have required millions in infrastructure 20 years ago. And that's what we did at Renaissance. We didn't try to be better traders. We built better systems and we got out of their way. The people who win in the age of AI will do the same thing. They'll stop competing with machines. They'll start leveraging them, building them, directing them, and most importantly, trusting them, even when it feels wrong. So why aren't more people successful? Same reason they weren't successful 40 years ago. Discipline. You can have the best system in the world, the most sophisticated algorithm, the cleanest data, and you'll still lose money if you override it. If you let emotion creep in, if you think you know better, the barriers are gone. The tools are democratized. Anyone can build what we built. The code is simpler, the data is cheaper, the compute is faster. That's the modern lesson. In a world where everyone has access to powerful tools, the competitive advantage shifts from intelligence to discipline, from knowing what to do to actually doing it, consistently, without deviation, even when it's uncomfortable. Most people can't do this. They read about systematic investing. They understand the logic. They build or buy a strategy, and then they sabotage it. They second guess it during drawdowns. They chase performance during winning streaks. They tinker with parameters. They turn it off when it's losing and back on when it's winning. The edge isn't in the system anymore. The edge is in the ability to follow it. I see young investors today making the same mistakes I made in 1978. They're smart. They're educated. They have better tools than I ever had. But they can't get out of their own way. They're reading news, forming opinions, making predictions, trying to outsmart the market. All the things that don't work, all the things that never worked. They destroy the only thing that mattered, consistency over time. Here's what I'd tell them if they asked. Stop trying to predict. Start trying to observe. Build something that reacts to what is happening, not what you think will happen. Test it thoroughly, not for weeks, for years, decades if you have the data. And they're ignoring the one thing that does. Systems, data, discipline. Then run it and don't touch it. Now let me bring this forward to today, to the world you're living in right now, because everything I've told you about markets applies to something much bigger. Artificial intelligence. We're living through a transition, the same transition we went through in finance 40 years ago. The moment when human intuition stops being the most valuable asset, when systems become better than experts, when algorithms outperform instinct. It's happening everywhere, in medicine, in law, in engineering, in creative work. The same pattern repeating across every domain. And most people are responding exactly the way traders did in the 80s, with denial, with resistance, with the belief that their experience and judgment will always matter more than data and computation. They're wrong, not because humans aren't brilliant, but because we're inconsistent. We have limits. We get tired. We're biased in ways we can't even see. And in any field where decisions can be quantified and outcomes can be measured, systems will eventually outperform us. This isn't a prediction, it's math. But here's what matters. The lesson isn't that humans become irrelevant. The lesson is that humans need to change their role. Stop trying to be the smartest person in the room. Start building the room. And that's what we did at Renaissance. We didn't try to be better traders. We built better systems and we got out of their way. The people who win in the age of AI will do the same thing. They'll stop competing with machines. They'll start leveraging them, building them, directing them, and most importantly, trusting them, even when it feels wrong. This is already happening in investing. You have teenagers today building algorithmic trading systems in their bedrooms, running back tests on free data, deploying strategies with a few $1,000s, things that would have required millions in infrastructure 20 years ago. The barriers are gone. The tools are democratized. Anyone can build what we built. The code is simpler, the data is cheaper, the compute is faster. So why aren't more people successful? Same reason they weren't successful 40 years ago. Discipline. You can have the best system in the world, the most sophisticated algorithm, the cleanest data, and you'll still lose money if you override it, if you let emotion creep in, if you think you know better. The edge isn't in the system anymore. The edge is in the ability to follow it. That's the modern lesson. In a world where everyone has access to powerful tools, the competitive advantage shifts from intelligence to discipline, from knowing what to do to actually doing it, consistently, without deviation, even when it's uncomfortable. Most people can't do this. They read about systematic investing. They understand the logic. They build or buy a strategy, and then they sabotage it. They second guess it during drawdowns. They chase performance during winning streaks. They tinker with parameters. They turn it off when it's losing and back on when it's winning. They destroy the only thing that mattered, consistency over time. I see young investors today making the same mistakes I made in 1978. They're smart. They're educated. They have better tools than I ever had. But they can't get out of their own way. They're reading news, forming opinions, making predictions, trying to outsmart the market. All the things that don't work, all the things that never worked. And they're ignoring the one thing that does. Systems, data, discipline. Here's what I'd tell them if they asked. Stop trying to predict. Start trying to observe. Build something that reacts to what is happening, not what you think will happen. Test it thoroughly, not for weeks, for years, decades if you have the data. Then run it, and don't touch it. When it loses money, don't panic, check that it's functioning as designed. Verify nothing fundamental is broken, then leave it alone. Let probability do its work. When it makes money, don't get excited. Don't increase your risk. Don't tell people about it. Just let it compound.
Be boring. Be systematic. Be patient.
This advice sounds simple, maybe even obvious, but almost no one follows it because it requires giving up control, giving up the narrative, giving up the feeling of being smart. It requires humility, and that's the hardest part. Not the math, not the coding, not the analysis. The humility to admit that you're not as smart as you think, that your intuition is flawed, that your experience might be leading you astray. That a dumb machine following simple rules might be better than you. Renaissance succeeded because we accepted this early. We built an entire organization around the principle that humans are the weak link, that our job wasn't to make decisions, it was to build decision-making systems, then trust them. That same principle applies today to everything, not just trading, not just investing, but to how you navigate a world increasingly run by algorithms, by AI, by systems more complex than any individual can understand. You can fight it. Insist that human judgment still matters most. Hold on to the belief that expertise and intuition will save you. Or you can adapt. Learn to work with these systems. Build them. Guide them. But ultimately, trust them. The people who do that will compound. The people who don't will get left behind. Not because they're not smart, but because they couldn't let go. I'm 86 years old now. I've spent most of my life solving puzzles. Some mathematical, some financial, some just about how to live well in a world that doesn't make sense. And here's what I've learned. The answer is never where you think it is. When I started in finance, I thought the answer was in prediction, in being smarter than everyone else, in seeing the future before it arrived. I was wrong. When I built Renaissance, I thought the answer was in the algorithms, in the models, in the sophistication of the mathematics. That wasn't it either. The answer was simpler. The answer was acceptance. Acceptance that I couldn't control the market, that I couldn't outsmart it, that the best I could do was observe it, build systems that could process what I couldn't, and then get out of the way. That's not just a trading philosophy, it's a life philosophy. Most people spend their lives fighting reality. Fighting the market, fighting their circumstances, fighting themselves. They exhaust themselves trying to control things that can't be controlled. And they miss the things they actually can control. Their discipline, their process, their consistency. I've made a lot of money, more than I ever needed, more than I ever wanted, honestly. But the money was never the point. The point was the puzzle, the satisfaction of building something that worked, of proving that reason could triumph over chaos. And it can, not by controlling the chaos, but by finding order within it, by building systems that can navigate it, by accepting that you'll never understand everything, but you can understand enough. Enough to survive, enough to compound, enough to build something that lasts. I look at the world today, and I see the same patterns everywhere. People chasing certainty in an uncertain world, looking for guarantees that don't exist. demanding control over things that are fundamentally uncontrollable. The market, the economy, technology, the future. None of it can be controlled, but all of it can be navigated if you're willing to think differently, to build systems instead of making bets, to trust process over prediction. This is what I've spent my fortune on since leaving Renaissance. Education, scientific research, mathematics, not because I think it'll make people rich, but because I think it'll make them rational. And rationality is the only competitive advantage that matters anymore. The world is getting more complex, not less. More data, more variables, more uncertainty. The people who succeed won't be the ones who know the most. They'll be the ones who can build systems to process what they don't know. Who can stay disciplined when everyone else is panicking? Who can trust the math even when it feels wrong? That's the skill. That's what separates winners from losers. Not intelligence, not education, not even hard work. Discipline, consistency, humility. I started this by telling you about a rule. The rule that changed everything for me: never override the system. But that's just the surface. The deeper rule is this: trust the process more than yourself. Because yourself is flawed, your intuition is biased, your emotions are unreliable, your memory is selective, your confidence is often misplaced. You're human, and humans are amazing at many things, but consistency isn't one of them. So build systems, not just in trading, in everything, in how you work, how you make decisions, how you invest your time and energy. Build systems that reflect your values, your goals, your understanding of how the world works. Then follow them, even when you don't want to, even when they're producing results you don't like, even when everyone around you is doing something different, because systems compound, just like returns. Small advantages repeated over time become massive advantages, but only if you don't interrupt them, only if you stay the course. I've had 40 years to reflect on Renaissance, on what we built, on why it worked when so many others failed. And the conclusion I keep coming back to is this: we won because we were boring. We didn't try to be heroes. We didn't make bold predictions. We didn't bet the farm on our convictions. We just ran the numbers. Every day, every trade, every decision, we let the math do the work. And the math compounded into something extraordinary. That's available to anyone. You don't need to be a genius. You don't need an MIT education. You don't need billions of dollars or access to proprietary data. You just need a system, a process, and the discipline to follow it. Most people won't do this, not because they can't, but because it's not exciting. It doesn't feel special. It doesn't feed the ego. There's no story to tell, no moment of brilliance to celebrate. It's just the slow, patient accumulation of small advantages compounded over time. But that's how everything meaningful gets built. Not in bursts of inspiration, but in consistent application of sound principles. Day after day, year after year. I've lived long enough to see trends come and go. Bull markets and crashes. Bubbles and panics. Revolutionary technologies and forgotten fads. None of it matters as much as people think in the moment. What matters is whether you can stay in the game, whether you can keep compounding, whether you have the discipline to stick with what works, even when it's unfashionable. That's the only rule, and it's the hardest one to follow. I built Renaissance. We beat Wall Street for 40 years. We compounded at rates people said were impossible. And I'm telling you, the secret wasn't secret at all. It was discipline. It was systems. It was the humility to trust math over intuition. That's it. That's the whole story. Everything else is just noise.